All right, we're live. Hi, everybody. Welcome to Passive Wealth Geeks. Today, I'm joined here by Alex Perney from Advanta IRA, and we are going to talk about self-directed IRAs. This is a really cool tool, especially if you're interested in adding like another tool in your investment toolkit. And we're going to talk about all of this, like what all is involved in the self-directed IRAs and how you can kind of utilize it and why do you even need to know about it. So without further ado, I'll pass it over to Alex, who can give a brief introduction and talk about what is this self-directed IRA.
Hey, appreciate you having me on today. Yeah, so a little bit of background on myself. I kind of am one of the few people that really started their whole career in this alternative asset space. Right out of college, I was looking for a job in finance, and this is the first place I kind of landed. So I've been doing this since the beginning of 2012. So I'm going on my 11th year doing this. I started my career with actually, hands-on doing investments for clients. I was involved in over 1,300 different individual deals for clients, spanning everything from private stock, single-family real estate purchases, a lot of limited partner commercial real estate deals, and basically any other weird type of alternative that people want to use our service for. I say weird, but I will say unusual maybe would be a better adjective for that. But with that said, I kind of elaborate on that just to the point that I encourage people to ask questions. If you have a question for me, I'm sure my contact information will be out there. But just because you don't see something that fits into a defined box, especially what we're talking about here being more geared towards commercial real estate, limited partner deals, and things like that, just because you maybe have a different idea of what you'd like to do doesn't mean there's not necessarily a path forward with IRAs. And the name of the game with this is helping people to avoid taking large taxable distributions from their IRAs to do a particular investment. A lot of people, if you're really new to this, think, hey, if I want to invest in this project, I have an IRA, it's where a lot of my capital is. How do I get access to that? I have to take taxes and penalties, and people kind of shy away from this large chunk of capital that, for lack of a better term, is languishing. Stock markets are extremely volatile. There's something to be said for that. Real estate, while yes, it does have different cycles and there are different market trends, in general, real estate has done this kind of thing over the past 45 years. It dips a little bit, but you look back, it generally goes up, as a good measure of inflation. So, that's me kind of in a nutshell. I could go on and on about, exactly who I am, what we do, but we're going to get more into that, I'm sure, here in a few minutes. But that's
a pretty awesome. That's a pretty awesome background, and it's good to know like you have like so much wealth of knowledge beyond like just real estate and when it pertains to IRA, like stocks and mutual funds and all of that. So that's going to make the conversation a lot more interesting. I mean, I just want to shed a light on like most of us who are especially in a W-2 job, we've been programmed to think about, okay, either we invest in a 401k or we don't. And the folks who do, a lot of us who do, they will be programmed to, okay, I'm going to put like 6 or 10% of my income, bi-weekly income, and I'm going to keep putting it in the IRA, in the 401k. And then the only option I have after that point, or if I have an IRA to which I'm contributing, only option I have is those Vanguards or those, Fidelity or whoever is the company, but, those specific like mutual funds, which I'm going to put it for the next like 40, 50 years. And that's all I can those are all my options and nothing outside of it. And now what you're bringing on the table for the folks is there's like a lot more that you can do with that, not just 401k, but there's a bridge of gap between what's a 401k and then what's a self-directed IRA. And this is way more powerful in terms of what all you can do. So that's if you can like highlight the basics over there, like how, what is it like and how is it different from your 401k?
Yeah, so it's important to kind of understand a few things when, kind of unpacking what you said. So again, most people are inherently familiar with what a 401k is. It's a type of tax advantage retirement plan. Same thing with an IRA. Most people, at least on a very high level, are understanding what exactly those two things are. And most people, again, are under the assumption that, your only investment choices with these types of funds are, what you're with an employer, they have their 401k with Fidelity. Okay, great. They have it with Vanguard, whomever. And you just kind of go with that. And then if you change jobs and you roll to an IRA, then it's just kind of more of the same. It's like, all right, well, I had my 401k with Fidelity. I rolled it to a Fidelity IRA. Now I just basically do the same thing with a different type of an account. So the important thing to kind of understand on a base level is what you can and can't invest in. And it's a lot easier to understand what you can't invest in, because when you understand what you can't, then the rest of it is allowable with some very basic rules. Essentially, the IRS states that you can't invest in a few things. You can't buy a life insurance policy with an IRA, and you can't invest into things that are collectibles. So, rare bottles of wine, artwork, things like that, things that you cannot invest into directly with an IRA. And you also can't utilize an IRA-owned asset. Now, this plays into effect of people investing in real estate, not so much the commercial multifamily side, because if you invest as a limited partner, you're not living in that apartment complex. You're not going and doing the work on it. This is more geared towards people that say, hey, real estate would be a great idea. Maybe I buy my own single-family rental property with it. You can't stay in that rental property. You can't do the work on it. But again, so long as you're not doing the work, personally utilizing the asset, it's not collectible, and it's not a life insurance policy, anything else you can cook up can typically be done through an IRA. So when people say, hey, what's a self-directed IRA? Well, a self-directed IRA it really doesn't technically exist. And that's kind of the cool thing. It is marketing. IRAs are basically constricted by the ability or the want of the company that administers it to allow certain types of assets. So Fidelity could do what we do. They're not going to. They make more money than they know what to do with on stock trading. But it opens up the door for people like us to allow for alternative assets. And that's where the term self-directed comes into play. I just was talking to someone yesterday, is why I kind of wanted to clarify, is that, a self-directed IRA, or someone might say a real estate IRA, those are just marketing terms. IRAs inherently in their DNA are the same. There's nothing special per se about the type of account you have here versus Fidelity. The specialness comes in the service that gets provided by the custodian, in this case Advanta, of what we allow for our clients to do. They do stock, bonds, and mutual funds at your Vanguards and your Fidelities. We do everything else, all of the hands-on stuff, real estate, private stock, all that kind of stuff where you probably understand it a lot better than you do the inner workings of the securities markets, are what we allow for clients to dive into and hopefully make a very good return on their investment.
Oh, that is pretty cool point. So I caught on to one of the things you mentioned about investing into real estate, but it cannot be so you mentioned a few points, right? One is the single family versus commercial. Plus you also talked about this cannot be your own personal residence. It has to be like kind of an investment property. So that was good. So I guess like any long-term, short-term rentals is possible, you would say?
Absolutely. And that's the nice thing as well, is that there's no prescribed investment strategy that the IRS has. Whatever you find to be a good fit is something that you can work well with. So for instance, we're down here in Florida, and this part of Florida we're in is the St. Pete, Tampa area. Short-term rentals are big down here. Granted, there's a lot of local municipal pushback on Airbnbs and stuff, but in general, Florida's big for Airbnbs. So we have clients that do very well buying the vacation rental market, very short-term stuff. Granted, you have to worry about things like sales tax on your rental income and some other. It's a higher expense ratio asset class than something where you're trying to rent for someone for 30 years. Not to say we don't have clients that do that, but the point I'm getting across is that whatever strategy you can come up with you feel is viable for your IRA or what you want to be doing, there's nothing stopping you from doing that. If you want to do the long term, you want to do the short term, if you want to fix and flip the property, whatever you'd like to do with it, or do, lease options and, get into all sorts of fun stuff. If you have the knowledge and willingness to do it and think you can do well with it, an IRA can typically work to a very good advantage for doing that with real estate.
That's pretty cool. And then you mentioned like about commercial. So is it possible, like potentially, is it possible to also participate in syndications and participate in using your IRA, be a part of a deal for, let's say, multifamily or apartments or that kind of stuff?
Absolutely. So in general, to kind of make sure that we're talking about the same thing, because I don't know what what spectrum of understanding your audience has on, investing in commercial real estate. But in general, when people talk about investing in commercial multifamily or, industrial real estate, they put together limited partnerships where you're buying into kind of a private stock, if you will. You become a limited partner in this particular deal, and it's very passive in nature. So can an IRA do it? Absolutely. If you have someone that's putting together a fund to take down, X, Y, or Z apartment complex, your IRA can definitely plug into that. The only time I tell people to be a bit concerned is a few different items. One is make sure you understand what you're getting into with limited partnerships and commercial, like syndicated investing, because while it is investing in real estate, it's very different from just buying a single family home. What your responsibilities, your rights, everything that goes into being an investor in that is markedly different from just buying a single family home. Can an IRA do it? Absolutely. The other thing is that if you are personally involved in the deal, not meaning that you're also a personal investor, you can invest right alongside your IRA personally. Yes. Say, hey, I want to put in 50 grand personally so I can get some personal income. I want to put in 100 grand for my IRA. Not a problem if you're both coming in as limited partners. However, if you're in a more active role within that syndication, let's say you're a general partner or you're a service provider to that syndication, you need to be a little careful with that. And that's kind of a case-by-case basis where I tell people, talk to us. You might need to talk to an attorney. But again, people here talk to an attorney and they shy away from stuff. I would much rather personally, or tell any one of my clients, paying for $300 of an attorney's time to save you the headache and the expense of dealing with the IRS is cheap insurance. If they give you the thumbs up, great, you're good. If they say, you know what, I wouldn't do that. Yeah. 10% of $100,000 is 10 grand. Not to mention taxes you might have to pay on that if you have to take it as a distribution, and another 10% if you have to do it as an early distribution. So you're talking about losing 40 grand in taxes and penalties on a simple mistake if you were to run into one. Again, when I tell people to talk to an attorney, it's cheap insurance. The amount of money you can save and the headache you can save yourself, again, but most people don't need to. If you find the deal's good, if you are comfortable with the people that are running the deal, the general partners, their experience level, what the rate of returns are, you want to plug your IRA into a syndication, go for it. There's nothing stopping you. Just be leery if you are a general partner or if you are more actively involved with the investment. Give us a call. We can kind of guide you through that.
Got it. So in net, simple investments, good to go. When it becomes more complex or syndication, figure out your investment details and figure out if the investment is making sense. If you have questions, reach out to the right legal advice or reach out to you guys. So those are basically the ways to kind of go about it. I mean, it makes total sense, right? Like you have to hedge your risks, definitely.
Yeah. And it just comes down to doing research most of the time. Anything. Yeah, just do research. The due diligence you need to do for an IRA doing these investments doesn't really change. What you need to do to be comfortable with it really inherently is not any different than if you were doing it personally. I tell people, if you feel comfortable to do this personally and you want to use your IRA, you don't need to rewrite the book and go back and look at a whole different set of numbers. If you think it's a good deal, it's going to pretty much be a good deal for your IRA insofar as, like I said, your due diligence. It's not all that research can kind of be combined to use whether you're using personal funds, qualified retirement funds. It's that's the nice thing about it is that just because this might be a new way of looking at investing or a new vehicle doesn't mean that you have to learn a whole new set of guidelines for doing something as simple, I shouldn't say, something as important as due diligence.
I mean, that's the exciting stuff. I want to throw another question at you. Like what I've in some of my conversations with people who are investing in short-term rentals, long-term rentals, they have few of the folks I've talked to have come up with that they've taken loans out of their 401k, different thing, but they have their 401k and they took a loan out of it and they're paying the think 6% or whatever, they pay a percentage back, which comes back to their, essentially they're paying themselves an interest rate. How is, conceptually, obviously these two are different things, but is there a advantage, disadvantage to one versus the other that you can shed some light on?
Sure. It really is kind of dependent on the individual client. So what you just mentioned, to kind of give it a little bit more of a technical aspect, what you talked about is called a participant loan. If you're in a 401k, this does not apply to IRAs. IRAs do not have this option. If you're in a 401k, which is an employer-based plan, you're allowed to take out a loan. So you actually borrow money from the plan, and it can be up to $50,000 or 50% of your total vested balance. So if you have $100,000 or more, you're capped at 50 grand that you can take out as a loan against that plan. If it's, 80 grand, you can only take out 40, 30, X, Y, and Z. It goes down like that. So what does that mean? Well, if you take out the loan from the 401k plan, it's just like if, I borrowed money from you, I give you a certain interest rate, there'd be a certain payment schedule, and I'd have to repay it in a certain amount of time. Same thing happens here. You agree to repay the loan to the IRA, can be to the 401k, my apologies, has to be paid back within 5 years, at least a quarterly payment, and the interest rate is a point above or below prime. Again, that's the technical aspects. The important part about what you asked me, though, is what is the benefits or downsides to doing one versus the other? Well, a benefit of doing the loan is that you get to receive all that income from the investment personally. So if you took out a $50,000 loan from your IRA, from your 401k, and you did an investment and it was paying out 10% on that money, then that 10% would come to you personally. Granted, that would be taxable to you personally, it'd be personal income to you, however you have it structured. It's your money to do with what you want to. You can't take those earnings on those funds and then put them into the 401k. The only thing you can do is just repay that principal and interest back to the 401k. That's it. So, for example, if you took the 50 grand out and put it on black in Vegas, doubled it, you can only put back in the 50 grand. The other 50 is taxable to you personally. So that's where you kind of have to look at it, is that any returns on that money you use from that loan are personal to you, which could be a benefit. The idea of this is that if you're putting this money into this plan, you're probably locking up a lot of capital. Life happens. You need access to it. That's how you do it. So I'd say look at that from the aspect of personal expense, like emergencies. And what that means to everyone is different. But from the investing standpoint, why not just do it directly through an IRA or a 401k? Why extract it from that tax shelter? Because if the 401k could make the investment, let's say it was allowable for the 401k to do it, why pull it out of the tax shelter, get taxed on those earnings, and then when you go to reinvest those earnings outside of it, you're always going to be taxed. It's just, you're constantly in that cycle of taxation. Whereas if you just did the investment through the 401k plan or rolled it out to an IRA, none of those earnings are taxed. Then you get to continually keep that compounding interest effect within that tax shelter, and you get to grow your money at a much faster rate. So again, is there a use case for a participant loan? Absolutely. Do people use them correctly? In my opinion, most of the time, probably not. But who am I to say if it's something you feel is a good fit? But again, it goes back to understanding what you can and can't do with these plans, because most people do it not knowing that you could have actually done the investment in that type of plan to begin with. And then that's when you kind of, run into the effect of, oh, well, why not have just done it there?
I think you brought up such an interesting point, because it is exciting immediately to think about it. Okay, you're taking money out of you're getting a loan from your 401k and you're paying a percentage back, but you're getting taxed on it. And your mindset basically doesn't make you think about that taxing thing. But when you look at you are still getting your regular income from, let's say, a W-2 job or other side hustles. And now you're just expanding your taxable income with that additional stuff that is coming in, and that just increases the tax burden. But you're right, it really depends on situation to situation, and in some cases it might really work out, but in other cases, the IRA might be a much better option. So that is exciting. Can you talk a little bit about so we talked about the loan from the 401k. When can I so I have my IRA, which is growing every year. It'll be compounding because I'm putting the money back. Whatever I'm earning, I'm putting back in it, right? When do you cash it out? So it's like you kick the can down the road till retirement, right? And then you can kind of cash out everything. Is that right?
Ideally, you never really need to, but it's nice to be able to have, a sizable nest egg that you've built up. But to answer your question of when you can take it out, It kind of depends on which plan you're talking about. So for an IRA, and this is Roth or traditional, when you can start taking penalty-free distributions is 59 and a half. Now, the same rule applies to penalty-free distributions from a 401k as well, meaning that if you took money out and you're 48, you might have to pay taxes and a 10% VIG to the IRS for taking that money out. So you take out, let's say you're 45 and you take out 10 grand from a retirement plan, you have to pay a 10% penalty. It doesn't matter if it's Roth or traditional, with an asterisk on the Roth, is that if you're taking, and there's some things to be explained there, but if you take out a $10,000 distribution, you automatically have to pay $1,000 to the IRS, plus you claim it as additional income that given year if it's pre-tax. So waiting till you're at least 59 and a half is a definite benefit that a lot of people hopefully are abiding by, because having to pay a 10% penalty plus taxes on stuff, I mean, it gets expensive really quick. Now, the cool part about Roth IRAs is that they have what's called accumulated basis. So anytime you make a contribution to an IRA, let's say over 3 years you had contributed $5,000 a year, you have $15,000 of basis. Now, let's say you had $5,000 of accumulated earnings, so you have 20 grand in that account. At any point, you could take a $10,000 distribution from that plan, tax and penalty free, but you'd be removing your basis first. So you have 20 grand total, 15 grand of basis. You take a 10 grand distribution, you now have $10,000 with $5,000 being basis and $5,000 being earnings. Let's say you took out the full 20,000 from that Roth IRA in that same scenario, you're under 59 and a half. Then you would have $15,000 of completely tax-free money coming into you. But that 5,000 of earnings would be taxed and penalized because you're taking an early distribution. So the Roth IRA stuff really only applies to the earnings on the account, and you always distribute your contributions first. So especially for younger investors, if you're saying, hey, putting money into these plans locks it up till I'm 59 and a half, what happened? We all just went through COVID, who knows what could happen? Literally the world could shut down and I need access to this money. Thankfully, we're on the other side of all that.
Really?
But it illustrates the need for understanding the rules really well, because especially for younger people, they don't have the ability to absorb large life events as well. Roth IRAs are awesome because, one, not having to pay any tax in retirement is better than paying any tax. I mean, it doesn't matter if it's 1%. If you can pay none, it's better than anything else. And also having that kind of built-in rainy day fund from that plan as well is a really big benefit. So, to answer your questions on, the differences of when you can start taking money out of there, it kind of depends on which plan you have. Roth IRAs and Roth 401ks offer a lot more discretion as to what you're taking out of them, because you do have the ability to take tax and penalty-free distributions basically at any time, because the IRS says, hey, you've already paid tax on this. You can take it out when you want to. It's just the earnings you have to worry about. The accounts where you're really locked in are your pre-tax accounts. So, traditional IRAs, traditional 401ks, SEP IRAs, simple IRAs, because there's never been any tax on it. They're giving you a tax break for putting money in. So the flexibility for getting money out really isn't there until you're 59 and a half. So, it's kind of a long-winded way, but I like to be very specific with that answer when people ask it to me, because I think it bears importance in understanding it in a very specific level.
Got it. So I guess to a little bit break it down, the question, my question, so essentially it should have been, it's almost like I'm thinking about it, principle of what I put into my IRA, what happened, like in terms of Roth, what happens to that principle versus all the earnings that I'm earning on top of it. Let's say when I take it out when I'm 45, right? And so what you're saying is the principle is secure to be taken out, but the earnings will get taxed if you break it before. Did I understand that right?
Kind of. So to think about it in that instance, your principal in a Roth IRA is all of your contributions, called basis. Mm-hmm. And the earnings are the only thing you can't touch till you're 59 and a half. You can access your basis in that account at any point for any reason. Traditional pre-tax accounts do not have that.
Got it. And I want to touch upon one more thing on that. So let's say in terms of like real estate, right? Let's say, I bought a house, I'm 42, and then essentially when I'm I'm not going to cash it out till I'm retiring. and I have my house is like 100,000 worth, and now it is going to be at retirement, it's going to be, let's say, 400,000, right? What hap and let's say after retirement, I'm deciding to sell that house for 400,000. What happens to those capital tax gains, like for the, for selling it at a higher price? Does that got anything to do with self-directed IRA? Does the self-directed IRA care, or it doesn't
No,
matter,
so
right?
it's if you're talking about a personal residence, it's no bearing on your retirement plan. But let's say for sake of argument, you had bought a house, a couple of years ago for 150, and then it appreciated, had cash flow that came in, the appreciable gain of the property at sale. Let's say you sold it you doubled your money, you sold it for $3.
Right.
It just all goes back into the IRA. There's no taxes that are due. There's not even a tax return that has to be filed when your IRA just sells a property like that. It just, it's like, okay, think about it like this. If you bought, Microsoft or McDonald's for a certain price in an IRA, and then it doubled in value and you sold it, that's easy enough to understand. Most people get that part of it. When you start talking about different asset classes, all these different things start coming in, don't overcomplicate it. Most people understand IRAs better than they think they do. And I tell people, break it down in simple terms of, well, what would happen if you had bought stocks or a mutual fund or a treasury bill with an IRA? Would there be any taxes when they sold, or if they paid a dividend? And people are like, no. I'm like, well, think about a dividend like a rental payment, or for a commercial real estate deal, think about that like a partner distribution or like a K1 statement. All these things start to make a little sense when you draw when you start thinking about it as how analogous can I make this to what the more traditional stock market is. Most people, again, they understand this stuff better than they think they do because those rules all translate. Yes, there are some specific things that you need to be aware of, but again, you sell something, you made a profit, no taxation. If there's cash flow, dividends versus rental income versus shareholder distributions, not taxable. Just goes into the IRA's income, and you continue to build just as you would with a more traditional account, just using alternative assets.
That is really exciting. That I did not know that aspect. That's really exciting. That makes it more powerful. So can you share with us like a quick pointers on like what are the risks to be aware of when you're investing in self-directed, or when you're planning for your self-directed IRA? What are some of the things, the gotchas to think about?
Yeah, so I would say that any of the risks inherent with the investment that you would see personally are going to be borne by the IRA. So whatever the risk profile of the investment is, it's going to translate to the IRA. There's not an inherent kind of buffer, if you will. And if anything, you need to be a little bit more careful because, if you have a loss within your IRA, you can't claim that personally. Think about it. If you stole that stock and it went down, if you bought Coke at 15 and it went down to 10, you just eat that loss. There's no way to claim that or reduce your personal income. So again, the risk profile of the investment is going to be the same, if not amplified with an IRA, simply because you can't claim those losses personally. But the only thing that I would add on top of that is that one, doing your due diligence is incredibly important. This is the money, getting money into an IRA is a lot harder than just earning more money as a personal job. You can't just go in and say, hey, I'm going to work a W-2 for 15 grand a year or 50 grand a year and just put all of it in my retirement plan. You can't do that. There's certain limits. So it takes a lot more time to get money into these tax shelters. So being very careful and making sure that it just doesn't walk out the other door is very important. But the only other things that are specific to IRAs that I want people to really be aware of are just understanding some of those simple rules we talked about in the beginning. If you're investing in commercial real estate, there's a lot less risk of violating rules than there is if, let's say, you bought a single family residence. Because, if you invest in a limited partnership or a commercial syndication, you're not living in that apartment complex. It's probably not even near you for the most part. So you don't have to worry about, doing the work yourself, staying in the property, anything like that. It's very hands off. But, let's say you bought a single family home in your neighborhood. Yeah, you can't do the work personally. You can't stay in it. You can't have family members stay in it. That's when you start getting into assets that are like things that you can reach out and have the ability to kind of reach out and touch. That's where you need to be a little bit more careful. So especially with things like precious metals, real estate, single family real estate. You just need to be careful with those things. But if you're doing things like mortgage loans, lending people money, if you're doing syndication investments, private stock investments, the risk profile, again, amplified a little bit just because this money is very important and it's hard to get more in there and you can't claim losses. But, those are really the only few areas that I say be extra careful as, like single family or things you can reach out and touch.
So no matter what the shelter, you have to still think about the investment that you're making and whether it's prudent or not. So
yeah,
totally.
It's the due diligence. Your due diligence shouldn't change. If anything, you should be, doing more careful due diligence for your IRA because it's a lot harder to get money into these types of plans. If you lose it, it's a lot harder to build back up. If you had a great year personally and you lost 100 grand, but you made 300 grand, that's great.
Yeah.
Good for you. You lose 300 grand in an IRA, it's going to take a long time to build that back up.
Actually, can you tell us just a little bit about that? How much can you put into the IRA and and how frequently? And
yeah, absolutely. So IRAs, and this is always kind of fun. So IRAs are different than SEP IRAs, are different from 401ks when it comes to adding money in. I'll start with the simple ones. IRAs right now now that you can't contribute for 2022, we're looking at 2023. If you're under 50 and a half, you can contribute in $6,500 a year. If you're over, you get $1,000 kicker, $7,500 a year. Roth or traditional or a blend of both, doesn't matter. You can do whichever one you want. You just can't exceed that in totality. I won't get too far into the weeds, but there are going to be some additional changes to that coming with the last tax omnibus bill they called the Secure Act 2.0. There's going to be some additional tax savings in the next several years that are going to allow people as a household, a married household, over 3 years to contribute maybe up to 60 grand per household over 3 years, additionally to an IRA. So keep an eye out on that.
Wow.
I did an episode, shameless plug, an episode of my podcast about 4 weeks ago on the Secure Act 2.0 and did a webinar. So AdvantaIRA.com, check it out.
They're great resources. That is really cool. That's interesting. Okay.
Yeah.
Awesome. So about folks who are now very curious about it, they've just realized they've already crossed the path and they understand this and they're like, how do I now invest it? What are the super high level steps to go at it and creating their own self-directed IRA, and how does that work?
Yeah, let me just touch on the 401k contributions real quick.
Okay.
So your 401k contribution limits, again, are different. They're based on the amount of money you earn. Now, this can distill down if you're self-employed, you can have a solo 401k, or if you're working for an employer. The basic way it works out is that if you're under 50 and a half, you can contribute up to $22,500 of your income per year into the plan. It can be Roth or traditional, so either deductible or non-deductible. The other portion of that is what's called your non-elective contribution, which is the match, if you will, that the 401k plan that the employer puts in. Again, it's a little bit different depending if it's self-employed versus more traditional employer. I won't get too far in the weeds with that. But suffice it to say, the difference in total contributions, you can get up to $68,000 or it's $67,500 or $73,500, depending on your age per year into a 401k. So if you're a self-employed individual, or you've had a side hustle, or you make income outside the scope of your normal W-2, or if you're fully self-employed, 401ks rock for being able to get a lot more money into those plans a lot quicker. Because again, think about real estate. It's many things, but it's not cheap. You're not buying a whole lot of real estate for $6,000 or $7,000 a year going into an IRA. You can definitely get a lot farther, a lot quicker with the higher contribution limits of a 401k than you can with an IRA. So I'll say that again. I can expound on 401ks till the cows come home. I love those plans. I'm really big into the weeds and the technicalities of them, but suffice it to say, 401ks are awesome.
That is so cool. So you got 401ks and IRAs. These are the two big tools. And I think most of the folks already know about 401ks who are in W2 jobs and they have been contributing, for that's their numero uno plan. Let's say people have made that decision and they've made the decision to go to the next step and they've figured out, okay, yes, self-directed IRA, this is going to work for me, for my age where I am right now and what I'm planning for retirement. and how do they go? Like, what are the super high level steps?
Yeah. So if you
And
had an old employer or you're over 59 and a half, you can always roll those 401ks out to an IRA. If you're still employed with the employer, but you're 59 and a half, you can roll funds out to an IRA. So if you want to do some non-traditional investing like this, just contact the 401k administrator, say, hey, I'd like to do a rollover. They'll say, great, where are we sending it? Say, hey, mail it down to Advanta, we'll get it deposited. Again, very basic. If you have, let's say you don't have an old 401k, but you have an IRA, it's just as simple as opening up an account at your self-directed custodian, and then we pull the funds out of that account to do the investment with you. Again, it's real basic. 401ks, you tell them where to send it. IRAs, we pull the funds out over to our platform.
oh, that is interesting. Wait a second. So what you're saying is like, so even though you're like your IRAs are limited to amount you can kind of invest in it, but your 401k, if you're changing, like for example, you're switching jobs or you have a rollover, or you're basically 59 and a half, and you can roll over all the amount you have collected in 401k into an IRA as well.
Yep, exactly. So once you're 59 and a half, you can roll over funds out of a 401k. And keep in mind that transfers between custodians don't count against your annual contribution limits, nor do earnings. So earnings are unlimited, rollover amounts are unlimited. So you could roll over 1,000 or 1,000,000 and still contribute in, whatever up to your limits, and also make as much money as you want to as well. So, I hope everyone makes as much money as possible. But again, it's not limited by any type of factor with the IRS.
This is so exciting. Thank you so much. I mean, this has been super exciting and very good learning experience for me as well. And what I will do is I will share your contact details and a little bit bio about you in the description. So if folks want to reach out to you, if they can as well. But everybody also please do your own research for your own investments, and nobody can replace that. And talk to your attorney or CPA, for the tax related stuff. But
yeah, I just encourage people. The biggest thing that you can do is ask questions with this kind of stuff. The biggest one thing we didn't cover, but I'll give the biggest pain points that I see with this stuff, because it's my job to sell people on the service that we provide and doing this. That's my job, is to get more people to open accounts to do this kind of stuff. But I wouldn't be acting in good faith if I didn't tell you, what are, again, some of the drawbacks. One that we touched on is, you can't claim losses personally. If you have a loss in an IRA, it's just that. Things like, depreciation, amortization, stuff like that really don't apply in many cases to an IRA. There are certain instances with commercial real estate where they do apply. More of a technical use case scenario, happy to expound on that. But the biggest thing that I see people run into really is just timing. If you want to do something like this, having a deal, and I had one that happened this week, is a syndication out in Texas, and there's regulations for how fast this stuff runs. Client called me and said, hey, you know what, I'd like to get started with this investment. It needed to be funded this week. Because the account wasn't open soon enough, we had the soonest we could fund was this morning, when closing was Tuesday. So, getting the process started, if you're interested, getting it started sooner than later will save you. I would say that's like the biggest pain point for people is, doing their due diligence on the investment. Awesome. Great. Do it. But not realizing that doing stuff with a self-directed IRA is not as immediate as you're kind of used to. There's more paperwork. It is more involved on you as the client. It is not just clicking buy on McDonald's, Coca-Cola, or IBM on your Fidelity platform. It is more of it's more hands-on. And just, again, I'd like to set that expectation and that reality very well with people, because then no one's surprised. But when people are surprised, is that they call me and say, hey, I got this deal I'd like to close on Tuesday. I go, hopefully. We don't have anything. We haven't even started the process yet. So, again, that's what I'd like to leave people with is, one, hopefully they're interested and are thinking different about their retirement, and two, setting an expectation that is reasonable for clients as well. Because the last thing I want someone to do is have their first experience with self-direction be a bad one.
That is exciting. I mean, thank you so much, Alex. This has been a wealth of knowledge for sure. And excited to have you, and hopefully we'll have more sessions where we can geek out on some of the more specifics as well. So.
Oh, you're talking to the right person. I will put people to sleep Hopefully not to sleep. I love 401ks and like the minutia of tax compliance and some of the cool stuff that you can do with these things because, the people don't realize the IRS gives us a playbook on how not to pay them. It is not an easy book to read. It is not a fun book to read, but they do basically tell us how to pay them as little as possible legally. And that's the cool thing is that they give us the rule book and it's up to us to understand it. And there's some really cool stuff with regards to retirement plans and benefits that people just never hear about. So again, I would love to dig into that. I will nerd out on the 401k tax law for sure.
Yeah, I bet that's a good nighttime reading too, right?
It will put you to sleep quick unless you're really into it. So I'll stay up till 3 a.m. reading it. Most people might get through 2 minutes, but we'll see what we can do.
Well, that's awesome. Well, Alex, thanks again. Thanks for your time and thanks for sharing all the wealth of knowledge. Thank you so much.
Yeah, my pleasure. Thanks for having me.